On paper, a trading strategy is an elegant geometric proof. In reality, that elegance rarely survives the transition to live execution. Traditional economics relies on the foundational concept of homo economicus, the assumption that market participants are perfectly rational agents, acting solely to maximize their utility. Every back-tested trading strategy assumes this perfect discipline. It treats the trader as a machine that will cut losses at a precise mathematical coordinate. But live markets run on human hardware. During a high volatility drawdown, the rational agent disappears, replaced by a brain struggling to process the psychological toll of a shrinking account. Trading failure originates in the biological response to financial threat, which prioritizes survival over even the most sophisticated technical analysis. These cognitive biases actively sabotage risk management. To understand why accounts blow up, we must examine the neurological wiring that traditional finance ignores. The efficient market hypothesis argues that asset prices instantly and rationally incorporate all available fundamental data. A sudden drop of this magnitude challenges the idea of perfect efficiency. This V-shaped recovery suggests a market reacting to something other than a calculated shift in intrinsic value. During a panic, fear overrides mathematics. Selling pressure pushes asset prices into a deep discount, moving them far away from their actual fair value. Behavioral finance offers the necessary lens to measure these irrational anomalies, tracking how human emotion swings the pendulum of price. Extreme volatility reveals a market dictated by human psychology and fear rather than fundamental data. Prospect theory models this irrationality. We evaluate financial outcomes relative to a specific reference point, usually our entry price. In the gain domain, the curve flattens as profits increase. This concave shape represents risk aversion. We feel an urge to lock in a small win, settling for guaranteed rewards over full potential. Conversely, the loss domain curve is much steeper. Mathematically, the pain of a loss is twice as intense as an equivalent gain. This steep convex slope turns the trader into a risk seeker. Faced with a losing position, the human brain stops prioritizing safety. Instead of cring the trade, we hold on and take more risk. We gamble that the price will return to our reference point simply to avoid the agony of admitting the loss is real. This architecture leads to a predictable cycle. We gamble with our losses while cutting gains short. The disposition effect is the measurable result of this S-curve. It's the habit of selling winners too early and clinging to losers for too long. Traders experience cognitive dissonance during a drawdown, using technical analysis to justify emotional reactions. They might claim they are letting a loss run because an indicator suggests a reversal. The actual driver is the subconscious need to avoid the pain of admitting failure. The chart becomes a mirror for the trader's loss aversion. When selling a winner too soon, the trader rationalizes the decision as taking money off the table. Under the surface, they are simply reacting to the fear of watching a gain disappear. The trader remains unaware their market interpretation is filtered through a compromised threat response system. Without intervention, the subconscious mind will override a trading strategy to protect the trader's emotional state. These individual biases aggregate into systemic forces that accelerate volatility across global markets. The disposition effect ratio, or DER, tracks this on a macro scale, measuring losers held compared to winners sold. In stable markets, the DER stays below 1.0. Participants are disciplined enough to realize their losses. When a volatility shock occurs, millions of portfolios drop below their reference points at once. The aggregate market is pushed into the deep, convex portion of the loss curve. The ratio spikes above 1.0 as loss aversion freezes the market. Investors collectively refuse to sell their losing positions, creating a buildup of emotional pressure. Eventually, the pain threshold is breached. The market shifts from a stubborn refusal to sell into a synchronized wave of panic. Metrics like the herd measure show that individual analysis disappears during these moments. Participants stop evaluating value and simply rush for the exit simultaneously. These data points suggest that the prospect theory S-curve provides the psychological architecture for a crash. It explains how individual loss aversion synchronizes into massive, irrational liquidations that define a global crisis. You cannot think your way out of this. No amount of experience or trading psychology can rewire the human amygdala's response to financial threat. During a market drawdown, your capacity for objective decision-making is a rapidly depleting asset. Structural automation is the only empirically supported defense against these hardwired behavioral errors. You must externalize your risk, removing decision-making power from the human brain when it becomes emotionally compromised. An automated stop-loss acts as a circuit breaker for your biology. It severs the convex tail of the loss curve, preventing you from entering the gambling phase. Capital preservation depends on a system that physically prevents the trader from following their instinct to gamble for resurrection. A robust risk architecture is non-negotiable and mathematically driven. It replaces subjective judgment with rigid, systemic rules. This requires position sizing based on volatility-adjusted capital, utilizing tools like the average true range to set expectations. It mandates the placement of stop losses at key technical levels, such as moving averages, moving them away from emotional or round numbers. Automation replaces the unpredictable variables of fear and greed with a fixed, repeatable architecture. In modern markets, human emotional reactions are fully predictable data points for those who know how to model them. If you rely on subjective decision-making to cut a loss during a drawdown, you are not trading. You are simply providing liquidity for the algorithms that do.